Hi everybody, Dana Sparks, broker of Maximum One Greater Atlanta Realtors. And today's contract tip has to do with the increase in the mortgage interest rate and what do you do with respect to your real estate contracts. So stay tuned till the end, and I'm going to give you a special stipulation that will protect your buyers in the event of an increase in a mortgage interest rate to the point where your buyer either no longer qualifies for the mortgage or the mortgage payment is going to be an expense that the buyer is not comfortable paying. So let's back it up a little bit and talk about what is going on. So this is March 2022, and interest rates, mortgage interest rates, well, all interest rates are on the rise. We've got a lot of things going on. We've got increasing inflation in our economy, and so that creates a lot of movement in the financial markets that obviously impact the mortgage rates, the interest on the mortgage rates. So additionally, right now, March 2022, let me back up a little bit more. So since January, real estate agents and buyers have seen mortgage rates creep up a little bit from January till February. The Fed announced they were going to increase interest rates in March as a pre-planned increase to fight or to offset increasing the inflation. However, with the war between Russia and Ukraine, the interest rates have bounced down a little bit. So there is this added impact of that war that is having an effect on our economy here in the United States that also does impact the financial markets, including mortgage interest rates. But generally speaking, and there are lots and lots of articles about this online, please check with a lender whom you know, love, and trust. But the prevailing thought among the economists is that interest rates for mortgages will increase in 2022 and 2023. So what does all of that mean for our real estate market? Couple things. As an agent, if you have past clients who have a house or relatively recent clients who have just purchased a home, no, if they've just purchased, they're good. But anyway, that do not have an intention of selling their home, now would be a really good time to refinance if they are at a higher interest rate than what the rates currently are. So that would be a nice touch or a nice reason to contact your previous clients to let them know that all the economic indicators are that the interest rates are going to increase. And if they do want to refinance, now might be a good time to do that and put them in touch with a lender with whom you work on a regular basis. And like I said, know, love, and trust. Now, what about for new buyers getting into the market and purchasing a home right now? What is the impact on all of that? Well, a couple of things. Number one is if your buyers are on the fence, so to speak, now would be the time to get them off of the fence and actually go purchase a home, because with a lower interest rate, a buyer can afford or is comfortable with the mortgage payment they're going to get is going to buy them a bigger, a more expensive house than it is going to with an increase in interest rate. What does it mean for you sellers? You sellers, don't sit on the fence if you're thinking about selling, because as the interest rates go up, the buyer pool for your house is going to decrease. So we still have a lot of buyers on the market, but a buyer that qualifies and is comfortable with the mortgage rate for, let's say, a $400,000 house, now with as interest rates go up, they're going to start looking in a lower price range to handle the economic impact of a higher interest rate, what that means for them. What about new construction? So new construction is the proverbial real estate elephant in the room for a lot of reasons. The economy that we have been experiencing has impacted new construction in a variety of ways. And there's probably a whole nother video I can do on new construction builders that are under contract with some buyers right now. And due to the increase in materials and labor costs, they are going back and increasing the price on a buyer. And what is the impact on that? Contractually, financially, that is a whole nother video. So I am not going to get into that within the context of this video. However, if you are a real estate agent and you are working with a buyer who has qualified, there's two parts to a buyer's qualification at a particular interest rate. One is their qualification with a lender. Will a mortgage lender lend them the money based on this interest rate? So they qualify their debt to income ratio and everything else that a lender looks at. The other part of that is, what is the mortgage rate, the monthly fee, the monthly mortgage payment that a buyer is going to have to pay back the mortgage with this interest rate versus another interest rate. So there's two parts to this that we're looking at. One is from a qualification standpoint, and one is from a comfort level standpoint of the buyer actually making a monthly mortgage payment after they have the house and have secured the mortgage. So what do you do in the event, particularly with new construction, if the interest rates increase from the time a buyer goes under contract with a seller until the time that the buyer actually closes on the property and incurs that mortgage? And again, the impact is from a qualification standpoint and from a financial comfort standpoint. I bring up the fact of new construction because the point is, with new construction, if a buyer is buying a property, a house that has to be built from the ground up, that can take a period of several months before the house is built and they're ready to close on it, even if they go under contract with that right now. So, a couple of things. You listing agents, you need to be really careful if a buyer actually terminates a contract based on a financing contingency because the rate has increased from the rate that they put on the financial contingency exhibit. What do I mean? What am I talking about? Well, let's look at the contract. In the GAR, and this is also in the RE forms contracts, when you look at a financing contingency exhibit, if a buyer is purchasing a home and they are making their purchase contingent upon them being able to convince a lender to lend them money for a first mortgage, you have to describe that loan. And this information is all spelled out on the loan contingency exhibits and in the RE forms contract. It is spelled out on the purchase and sale agreement in and of itself. You have to indicate for a first mortgage the loan amount, in other words, what percentage of the sale price they're getting as a loan versus what percentage of the sale price they're putting down as down payment, the term, the length of the loan in terms of number of years, the interest rate, and is it a fixed, adjustable, and the source of the loan, institutional loan. In Georgia, it is a license law violation to make a contract subject to financing without filling this information in. So what did I mean by my previous comment about listing agents? Well, if a buyer is going to terminate a contract and attempt to get their earnest money back, and they're terminating it because they did not meet the financing contingency. Financing contingency means the seller gives the buyer X number of days to convince a lender to lend them that money. If not, the buyer has to terminate prior to that time frame and prove it with a loan denial letter from the lender. So with regard to rising interest rates, you listing agents, if you get a termination from a buyer based on a financing contingency, you need to look at that loan denial letter, because a buyer could get turned down for a loan because of an increase in interest rates. But in order contractually to protect their earnest money upon that termination, the loan denial letter must be, the loan that's being denied must be the one described in the contract via the loan contingency exhibit in GAR or in the purchase and sale agreement in the RE forms. If you're writing a contract on another contract package, you need to look at this information more specifically. And all of that is spelled out in the loan exhibits as well as in the contract for the RE form. So again, listing agents, make sure the loan denial letter matches the denial of the loan that the seller agreed to get them to pursue. It goes on there. A buyer is not required to get the loan that's outlined on the financing contingency. That's just for protection for their earnest money should they have to terminate based on the financing contingency. Now, back to the topic at hand with increase in interest rates. From a buyer's perspective, how do you protect a buyer in light of these increasing rates? Again, particularly with new construction, if the buyer is actually having that property built from the ground up, in which case it could be a period of several months from binding agreement date through closing date. Finally, what you've been waiting for. So, you buyer's agents, here is a special stipulation from the Georgia Association of Realtors, or GAR, that you would want to include in any purchase and sale agreement with a seller, especially right now with all the discussion about increasing interest rates. So you ready? Here it is. This is GAR, Georgia Association of Realtors, Special Stipulation 510, Interest Rate Fluctuations Prior to Closing. That's what it's called, and this is what you buyer's agents are going to put in a contract as a special stipulation. Buyer and seller acknowledge and agree that interest rates on first mortgage loans may fluctuate between the binding agreement date and the date of closing. Accordingly, buyer agrees that notwithstanding any other provision to the contrary contained herein, a loan with an interest rate not more than 2 percentage points higher than the interest rate set forth in any finance provision herein shall be acceptable to the buyer if the buyer has the ability to obtain such a loan. What that means in and of itself is a buyer is willing to go through with the contract should the interest rate increase by more than 2 percentage points than what was in the contract in a loan contingency exhibit for a loan contingency. Now, I would suggest you add a couple of other things. Number one, make sure that tolerance level, that 2%, before you add this special stip, you're going to want to have a conversation with the buyer's lender. You want to make sure that if the interest rate increases within that range, that 2% range, that a buyer is still going to qualify. The other piece that I would suggest you add to the GAR special stip as a broker is you would put in termination rights for the buyer with no penalty should the interest rate increase more than 2%. So you guys can figure it out with your buyer, and you can put in that increase. You can put 2%, 1.5%, 1%. That is going to be a discussion to have with the buyer and with the lender regarding what tolerance level they are going to be able to handle financially. And then I would add on, should the interest rate at time of closing, or probably you would back it up within 1 week of closing, something like that, that the seller will accept, be more that increase more than the 1%, 2%, whatever you put in there, from the interest rate as indicated in the financing portion of the contract. Buyer reserves the right to declare contract null and void under no penalty, terminate contract under no penalty with full refund of earnest money. So again, you're going to have to negotiate this with the seller and get a seller to accept it. But you buyer's agents, you need to remember to protect your buyers with the increase in interest rates. Hope this contract tip helped you out, gave you some things to think about, and a place to go for some verbiage for that protection, as well as you listing agents, some things to look out upon a buyer's termination under financing. Thank you guys so much for watching. Dana Sparks. This is Nami. The one at the beginning was Seema. Satisfying your needs with service, innovation, and education. Bye.